All right. So last week we did our introduction to accounting. We did 2 lessons last week. We did a lesson at 7 o'clock with Donnie, and we did a lesson at 8 o'clock with me. So remember what I said, that there are 2 classes here that we have. We've got introduction to financial accounting, and then we have got financial reporting and analysis. So the introduction to financial accounting lessons will usually be at 7 o'clock. Then the financial reporting and analysis lessons will be at 8 o'clock. Some of the stuff that you're going to learn, it's similar. Some of the stuff that you're going to learn is a little bit different. But for the stuff that is similar, sometimes we do like what we are doing today, where we can just combine the class so that we can just learn together and ask questions and whatnot. I believe Don is also part of the class at the moment, in case you might also have questions for him and etc. But anyway, what we want to have a look at today, I thought this was very, very important. So sometimes I will not really go through your study guide, guys. Just take note of that. Sometimes I might not go through exactly what your study guide says, but whatever we go through, it is important. The reason why I do that is there are certain things that I believe they are very key and critical for you as a student to understand right when you are starting to do accounting. Because if you understand those concepts, later on, we can explore those concepts in depth, right? But your basic understanding of these concepts will make it easier for you to understand some of the things that we are going to explain, some of the things that we are going to ask you to do. So that's what I want to talk about today, the generally accepted accounting standards. For the guys that are doing financial reporting analysis, this is the last time that you hear about this. But for the guys that are going to do BCom accounting, you actually have got a module in your year 2, which goes in depth about these things, which goes in depth about. So you will notice that it will give you more and more information. But for today, I just want you to open up your mind so that we can just have a short discussion about what these things are. Right. So remember, we said that there is management accounting and then there is financial accounting. And we said that management accounting, you can write whatever you want. But when you're doing financial accounting, you have to follow certain particular standards. So these are what we call the generally accepted accounting practices, right? So there is also, international financial reporting standards and all of those things. Not for today. We're not going to talk about that. Right? But I just want to mainly talk about what generally are you as an accountant, are you as a financial manager expected to understand about record keeping in accounting, right? So the first thing that you're expected to understand is what is called the accounting entity concept. So the accounting entity concept, we are saying that there is a separation between you, James, and the business. There is a separation between you, Nomvula, and and the business itself. You cannot combine the two, right? So if I do a transaction, so for example, I have a business which I'm running, Varsity Unlimited Tutors, right? And then I want to buy bread for my family. I cannot use my business account to buy bread for my family. If I use my business account to buy bread for my family, I do not record and say there is an expense for bread for Varsity Unlimited Tutors. That's wrong. So the accounting entity says that the transactions of the owner and the transactions of the business should be recorded separately, which means that within the business, you cannot record transactions that have nothing to do with the business. If I use the company card to swipe at the POS machine when I'm buying fuel for my car, for my own personal travels, I cannot put it on the journal or I cannot put it on the ledger of the business. I cannot do that, right? What I have to do is I have to record and say that I, the owner of the business, have withdrawn money from the business. So it's recorded as a withdrawal of money from the business, but it's not recorded as a fuel expense for the business because the fuel expense was not for the business, but was for me personally. I hope that's clear. If I explain something and it's not clear, please highlight, guys. We want to make sure that we understand these things. So that's the accounting entity concept. There is a separation between the owner of the business and the business. So do not record the transactions of the owner of the business in the business. If the owner of the business takes anything out of the business, you record it as a withdrawal or as a drawing, not as an expense. All right. Money measurement concept. Money measurement concept says that because we are doing accounting, right, we cannot say in our business, we are going to add buildings, we are going to add cars, we are going to add people. That's not possible, right? We need to change everything that we have into rands if we are dealing with South Africa. We need to add everything into rands. So we cannot have a financial statement that is in Pula, that is in US dollars, that is in rands, that is in naira, and etc. No, it has to be in one currency. It has to be measurable in terms of money. If someone says, okay, look, let's make a deal. Instead of giving you money, they say, I'll pay you in the form of a car. I'll give you my car as payment. You don't record and say received car. You say, I received money, you transfer that car into rands, and then you highlight the value of the car. So all transactions have to be accurately recorded as cash, as money, right? As South African rand. That is the unit of account. You cannot mix cows and cats and whatnot. You have to record it as what? As money. And if there are different currencies, record it as one currency, which means you need to change. You need to exchange and record it as one currency. So that's the money measurement concept. Then the materiality concept. Now, because you're dealing with money and because you're dealing with quite a lot of things, there are certain transactions that are material to a business, and there are certain transactions that are not material to a business. So there are two issues here on materiality, right? The first issue is what we call categorization. So if you ever find time, just search, let's say, balance sheet, right? You will notice that most balance sheet of companies, for example, on the Johannesburg Stock Exchange, they will say plant property and equipment, then accounts receivable, and then cash and cash equivalents. That's it. They won't go into detail and tell you that under plant property and equipment, they won't say, okay, we've got one car for 30,000, another car for 100,000, another car. They don't record it like that. So that's part of the materiality concept. We're saying that it is not material for you to list every single asset and say, I've got a chair, I've got a textbook, I've got all of these things when you're doing your financial reporting. It's material when you're doing your ledgers and your journals, but when you're reporting, it's not material. You only need to record the total, or you only need to put the correct subcategories of things. Don't put everything there. So that's the first part. Then the second part is you will also notice, if you look at financial statements, you notice that companies sometimes, they will say, 397, and then at the very top they'll put 3 zeros to show you that these are in millions or these are in 100,000. That's part of the materiality concept. They are trying to tell you that it is not material for you to know how many rands to the exact cent that, oh, this company made 13 million rands, 522.36 cents. That's the sales that we made. It's not material. You just need to know that they made 13 million. So they will just summarize it for you and round up certain things. So that's also part of the materiality concept. There are certain things that are immaterial when you're doing your business, which you can have a leeway in terms of how you record them. But there are also certain things that are very material that you do not really have a leeway in terms of your record keeping. Right. Then the next one is the historic cost concept. Now, this one is a controversial one, especially if you don't have a background in accounting. Historic cost concept says that when we record assets, right, we record them at the original cost that I bought the asset. So, for example, if you check the flat that I'm currently staying at, right, when I went through the abstract of the title deed, you notice that initially it was bought for, I think it was like 56,000 rand. But when I bought it for like 350,000, right? But when I record, I'm recording at 350. But the person who bought it initially recorded it at 56,000. They cannot change that because that is the original cost, regardless of the fact that over time, the flat can gain value, right? So I've bought it at 350. In 5 years' time, it might be worth 600,000. But when I record it at the original cost, less the depreciation, if there is any depreciation to be recorded. Now, for the guys that are doing BCom accounting, I know you're at my throat right now. Yes, there is revaluation of accounts. There's accounting for inflation. We're going to do that in our second year and in our third year. For now, let's assume that we are going to do it later. So let's not discuss it. Otherwise, it will become a problem. But the historic cost concept simply states that you record your assets at their original cost less the depreciation of that particular asset, regardless of the fact that the asset might no longer be valued at that much. All right. Double entry concept. Now, this one is quite important, especially for the BCom accounting students, is whenever we are recording our entries within our journals and our general ledgers and etc., we have to record them twice. There is always a debit entry and there is always a credit entry. So, for example, if you are paying for an expense, you are going to what? You are going to remove the money from the bank account. That is one entry. And you are going to what? You are going to remove the money from the what? From the expense account. That's the other entry, right? So there's going to be a debit entry and there's going to be a credit entry for each and everything that you are doing. It is recorded twice. We are going to talk about how do you record that in the general ledger and all of the tricks of how you can do that. That's something that we can do later on. And I'm sure Donnie will also cover that in his lecture next week for the guys that are doing BCom accounting. For those that are doing general financial reporting, you don't really need to get deep into this. You just need to know how to read the trial balance, which we are going to learn. All right. So double entry, for every debit entry, there is a credit entry. So for each and every entry that you are recording, it is recorded twice. It affects the accounting equation that we talked about last week twice. Right. So that's double entry. You will learn more about it later on when we start doing this stuff. Right. Going concern concept. So this one is tied back to the historical concept. The going concern concept simply says that whenever we are doing our record keeping, we assume that the business is going to exist next year, right? We assume the business is going to exist next year, which means when I'm recording anything right now, when I'm presenting information, I'm assuming in 2025, this business will still exist. If that is not true, then we have to do what is called the re-evaluation, i.e. we can no longer use the historic concept. If the going concern concept is not true, then we cannot use the historic concept. We have to re-evaluate. We now talk about net realizable value and all of those sort of things, right? But the going concern concept simply states that the business is going to exist next year. That's the presumption or the assumption that we are making, that we are not liquidating the business. Accounting period, this one is straightforward. Accounting period usually is 12 months. Yes, you can get into businesses that might record semi-annual and whatnot, but for most businesses, the accounting period is 12 months. Right. So when you say 12 months, normally is any 12 months. It can be January to December, February to January next year, June to May next year, it's something like that. Doesn't matter as long as it's 12 months. But however, if you are doing taxes, for your business, the accounting year for taxes is from 1 March up to 28 February or up to 29 February. That's the accounting year for taxes. So you will notice that usually in your exams, your lecturers, sometimes they match that. You will notice that you talk about the prepare the financial statement as at 28 February, blah, blah, blah. That's the reason for that, because that's the tax accounting year. All right, is that a question? Yes, it's called a fiscal year. Yes, it's called a fiscal year. Yes, that's correct. If you're talking about taxes, you're talking about the fiscal year. All right, let's go on. Where was I? I jumped something. All right, matching concept. All right, so matching concept. Any business that is operating, it has got income, it has got expenses. When a business is operating, it is going to have income and it is going to have expenses. Now, these incomes and these expenses, they are linked to each other most of the time. Right? So let me give an example what I mean when I say they are linked to each other. So for example, if you are working in a consultancy business, right? You're working in a consultancy business, you are, let's say it's a surgery, right? A referral surgery, right? Referral doctor, right? So the doctor is consulting, checking checking the patient and whatnot, right? And then when there are expenses related to a particular patient, okay, this patient, I did these particular scans. When we did the scans, we needed this particular type of medicine and etc. Then that patient pays 40,000 rand, right? The 40,000 rand paid by the patient is the income, is linked to the scan that the doctor did for that particular patient, to the medicine that the doctor gave to that particular what? To that particular patient. So there is a match between the income and the expenses of that particular patient. So that's what we're talking about when we're talking about the matching concept. We are saying that in each and every period that you are in, ensure that you match the incomes of that period to the what? To the expenses of that particular period. You have to match the incomes of that particular period to the expenses of that particular period. So this one is usually important when you have got incomes that are over longer periods of time. So for example, let's say that you're in construction and you have been given a big construction project, right? And then once you're given the big construction project, maybe you receive your income right now, or maybe you receive your income after 3 years when you complete the project. You cannot record all of your income right now and then do the project for the next 3 years. And then each and every other year, you're recording losses because you don't have income. That's wrong. You have to match that, okay, this year we're going to do 10% of the project. So we are also going to record 10% of the income. The next year, we're going to do 50% of the project. Therefore, we record 50% of the what? Of the income. So that's part of the matching concept, right? Then conservatism, this one now we are saying that, look, when you are recording revenues, right, do not overstate your revenues, right? Whenever you have to make a judgment about revenues or whenever you have to make a judgment about expenses or assets, do not overestimate your assets, do not overestimate your revenues, do not underestimate your expenses. Be very conservative in your estimate. Be very conservative in your estimate, right? I think it's self-explanatory. Maybe I can give an example of a bad debt. So if you are making sales on credit, right? You are making sales on credit as Mr. Price, you sell to your customers on credit, they open accounts and they buy products, right? And you know that your customers owe you 2 million rands. The conservatism will tell you that, look, some of those clients are not going to pay. And then you estimate, I think maybe 1% of them are not going to pay. So out of 2,020,000 rand might not pay me. So therefore, you're going to record provision for bad debts, 20,000 rand as an expense to the business and say, these people might not pay me. That's being conservative because you're saying, I don't think these people will pay me. So I'm not going to record it as income and say, I'm going to receive 2 million. Rather, I'm going to receive 1,980,000 rand. You are being conservative in your estimations of the revenue of the what? Of the business. Realization concept. says that income must be recorded as soon as it is earned and realized. As soon as it is earned and realized. It almost goes back to the issue of the matching concept, and also we're going to talk about the accruals concept later on. But we are saying that as long as you are reasonably certain that you are going to receive an income, please record it. So, for example, a company such as those companies that do subscription services, right? Those companies that do subscription services, if they're reasonably certain that you are going to pay your account without any problem, they'll record it as income for the period under duration, even if the money has not yet been received to them. Right? The money might not be in their account, but they have made the sale, you have signed the contract, and they are reasonably sure that you are going to pay whatever it is that you have signed for. So they will record it as a sale. That's also why we record credit sales. That's also why we record credit sales. When someone comes and buys something on credit, they have not yet paid us the money, but we record it as a sale, as income, because we are reasonably sure that we have already earned this income and it is going to be paid for. So that's the realization concept. So if there was no realization concept, then we don't record credit sales. But because we realize income when it is earned, we therefore have credit sales in our current income. All right. Then accrual concept. Now this one now applies to our expenses. It's just like the realization or matching, but it applies to our expenses. You have used your electricity for the whole month. You have used the water for the whole month. You have enjoyed the services of someone for a whole month, but you have not yet paid them. You have to record that as an expense. The fact that you have not yet paid them, it just means that you owe them because you enjoyed the water, you enjoyed the electricity. You're going to pay it anyhow. So though you have not yet paid it, you are still have to record it in your books as an expense. So you will notice that we will record and say that the rates, water, and electricity expense for the year was 50,000 Rand. But if you check in our accounting, in our bank account, you might notice that we only paid 30,000, which means we owe the city council and we owe ESCOM 20,000 Rand at the end of the day. So the accrual principle says that we have to record all expenses for that particular period, regardless of the fact that we might not have paid for those expenses. All right. So those are basically the concepts that I wanted to talk a little bit about today, so that you just have a basic understanding of what we are, of what accounting is all about. So I'm just going to introduce a little subject here. I'm not going to go into detail, maybe just for 5 minutes. I'm just going to introduce something here, because what I'm still doing is I want to build your vocabulary so that when we start doing workings, we understand each other. When we start doing workings, we understand each other. So in most businesses, we have someone called a bookkeeper, right? Or in some businesses, they are now called clerks, right? So a bookkeeper or a clerk, right, is someone who records the transactions that are happening in a business on behalf of the business, right? So for example, as a business, if some money comes in terms of sales, they record that we have received some money for sales. If we make an expense for fuel, they record that we have paid for fuel. So that at the end of the year, we have a proper record of every transaction that happened in the organization. So when they are doing this record keeping, that is what we call journals. That is what, if someone say, okay, create a journal entry, they are saying that, can you record a particular transaction? So that's what a journal entry is. It's a recording of a particular transaction of the business. And then when we combine the journal entries together, then we've got our accounts, which are within our ledgers. Our ledger is just like a book or a summary of all of the transactions relating to a particular to a particular journal. So within our ledgers, we've got different types of ledgers that you're going to. So you can go through some of these notes, but it's not really critical for me at the moment. For the guys that are doing BCom accounting, I'm sure Donnie will go through some of this stuff with you. but I want to talk about this, right? Okay, and this, let's talk about the ledger first, right? So there are different types of ledgers that a business will have. Remember, I said a journal entry is when you record a transaction, right? And when you summarize the transactions that you've recorded, or when you combine the transactions that you've recorded, you end up with a ledger. So a sales ledger is a summary or a combination of all of the journal entries relating to the sales of that particular business. A purchases ledger is a summary of all of the transactions relating to the purchasing activities of the business. A general ledger is a summary of all of the other transactions that the business is doing. So they've bought some property, they've got some salaries that they paid, how much money did the owners of the business contribute? It's all recorded in the general ledger. So those are like the key ledgers that you might have in a what? In a business. Now, let's go back to what I wanted to talk about now. So in each and every business, there are three types of accounts. There are personal accounts, real accounts, and nominal accounts, right? These accounts are what will make what is called the trial balance. And the trial balance is what we are going to use to prepare financial statements, which is what we are going to be doing next week. It's a very straightforward process. Don't worry about it. This is just background noise, right? Personal accounts is you are recording for particular people. When I say particular people, it can be an organization. So for example, if I owe FNB money, in my ledger, there's going to be an account for FNB. That's a personal account, right? If Donald comes and buys a particular product from the business, right? And then we record that Donald owes us money, that's a personal account, right? So we expect to receive some money from Donald, right? So that's a personal account. So that's a type of account that you'll find in the ledgers. There are personal accounts, which are accounts relating to whether they're organizations or people that we owe money to or that owe money to us, right? Then number two, there are real accounts. Real accounts are accounts for our assets, right? We've got land, we've got buildings, plant and machinery, stock, cash, and whatever. Those we record them under what we call real accounts. Now, personal accounts and real accounts, this is what usually gives us what is called the balance sheet. Right. So personal accounts, we don't go in the balance sheet and say Donald, James, and whatnot. We summarize them together and say the total number of people that we owe money to, and we call them creditors. It's personal accounts that have been summarized into one. So they are creditors. And we say the total number of people that owe money to us, and we call them debtors. And then that's again another personal account, but we've just summarized it into debtors. And then we've got our cash, which is our real account. We've got our property, which is real accounts and whatnot. So personal accounts and real accounts are what we usually find in the balance sheet when we start doing what is called the balance sheet or the financial statement position. The nominal accounts are what we use to record profit. Right. So nominal account shows us all of the incomes that we received, your sales and whatnot, and they show us all of the expenses that we faced. Right, your salaries, your wages, and etc. Right. So these are the three main accounts that you will see we'll talk about quite a lot as we get into what deeper into the study module. And then for those of you that are going to be doing bookkeeping and recording, this is what you need to know when you're doing your bookkeeping and your recording. Whenever it is a personal account and the person is receiving money from the organization, you debit, and the person is giving money, you credit, right? When it's a real account, whatever is coming into the account, you debit. Whatever is going out of the account, you credit. If it is a nominal account, expenses and losses, we debit. Incomes and gains, we credit, right? We are going to go deeper into this next week when we do the actual general ledgers and whatnot, right? But for the guys that are doing financial reporting analysis, we are never going to go back to this again. We're going to go straight into the balance sheet because you don't need to learn how to do the actual recording, but you need to learn how to interpret. So this is where I'm gonna end my class. I'm not gonna go too much deep into it, but let me give you a highlight of what comes next. For the guys that are doing BCom accounting, next week we are now starting to learn how to actually record transactions. So we are going to go through examples, right? Where we say, okay, the business has received this amount of money, how do I record it, and etc. Right? Then for the guys that are doing financial reporting and analysis, we are going to look at what is called the trial balance and how the trial balance can be used to prepare financial statements. The trial balance is a list of all of the different accounts. It's the list of all of the personal accounts, all of the real accounts, and all of the nominal accounts of the organization. And because we have that list of accounts, then we can prepare the statements of financial position, which is the income statement, the balance sheet, the cash flow statement, and etc. Right. So this is where we are going to end our lecture today. So in terms of theory, I am done covering the theory part of your study guide. The next part that we are going to be doing will be the actual calculations, where we are going to be doing, I think we're going to do income statement. That's what we're going to start looking at for the guys that are doing financial reporting analysis. We're going to be doing the income statement next week. We use the trial balance and we see how can we prepare an income statement or a profit and loss statement using the trial balance. We're going to be looking at how do we handle the adjustments that the lecturer would have given us, and what is the impact of these adjustments considering the concepts that you have learned about. So what I'm also going to do, in addition to this video that we did today, I am going to send you guys another video where I was teaching some students about how to do an income statement. The reason I'm doing this, because we don't want to spend a lot of time going through the lessons. We want to spend a lot more time practicing how to do it, because in the exam, you're not going to be asked theory in terms of how to do it. You're going to be asked to actually prepare the financial statement. So I want to come through the lecture with past exam papers that we can do together. So please make sure that you watch this video. Please make sure that you watch the second video, which is teaching you how to do the income statement. And then when we meet next week, I will just maybe explain maybe for 15, 20 minutes, and then we can do an example from the past exam paper in terms of how to prepare a financial statement. This is for the guys that are doing financial reporting and analysis. We are meeting at 8 o'clock. For the BCom accounting students, we meet at 7 o'clock and we are doing record keeping. If you want to attend also the 8 o'clock class and you're doing BCom accounting, you are free to attend. You are free to attend, but it won't really be relevant to you for now. It's something that you have to do later on, I think, in the middle of the semester after you have learned how to do your recording. Any questions for me before we dismiss for today? Remember, this is the last free class, guys. This is the last free class for those of you that are still interested and have not contacted me. This is the last free class. But I will send two videos, the one for today and the one just giving you an introduction of what we are doing next week. All right. If there are no questions, I think we can dismiss each other.
Thank you, James.
Sure.
Bye, James. Thank you.
Thanks, James.
Sure.
Thank you.
James.